Hello, welcome to problem solving session number 4. My name's Bob Boylan, and I'm here to work through a couple questions from problem set number 4. Let's get right to it. Problem set number 4, the focus for today's session is going to be completely on cash flow statements. And what we're going to be doing today in this session is two cash flows. One, question T4, is a relatively easy cash flow. T6 is a little bit harder. It's not a difficult cash flow question, but the numbers are a little bit bigger. It's a little bit more realistic. So we can expect to see a little more detail in the second cash flow. I want to remind you again that in any problem set that we have in this class, the questions with a T in front of them are questions from old exams, so that the T questions are similar to the kinds of questions that you will be seeing on either midterm or final exams. Also, remember that in this class, we emphasize in the financial accounting part of it anyway, we emphasize two things. One is present values, and if you've seen the other problem-solving sessions, we almost always do a present value question somewhere in there. You're not going to see present values in this session, but in general, present values are extremely important. The second thing that we emphasize in the financial accounting portion is cash flows. If you go back and think about problem-solving session number 1, virtually every question that we did forces you to understand how cash affects various accounts on the balance sheet and income statement. And so, I hope you can now see that throughout the whole course, what I'm emphasizing is for you to understand how cash affects organizations through understanding how cash is important in accounting. So that here we go. This session is the culmination of much of the financial accounting that we have been doing all semester long. Cash flow statements force us to understand everything in accounting and force you to integrate, understand how accounts relate to each other. Here we go. The first question is T4, and T4 basically is an income statement and a balance sheet. And I thought we'd review very quickly what's going on. Notice in this case, we have the beginning on the left, ending on the right. Or this could be 1991, that could be 1992, for instance. Because last year's ending balances are this year's beginning balances, and vice versa. So it goes on like that. A couple things to think about early on is, what is the difference in cash? In this case, cash increases from $300 up to $320. So there's a $20 increase in cash. That is going to be the focus of our cash flow statement. Other things to consider along the way: inventory increased, receivables increased, property, plant, and equipment increased, payables increased, accrued expenses went down, that liability account, income tax payable increased. All these things will affect our cash flow statement. The second page of information is the income statement. Notice up here, an item of property, plant, and equipment was sold at a gain of $40. We will use that later in our analysis. So these are all things that we will use. And the item had originally cost $140. On the income statement, sales $24.60, gain on sale $40. So total gains $22,500 less various expenses give us net income for the year of $360. And then at the bottom of the income statement is a reconciliation of retained earnings. And this is often a separate statement in financial statements when they're published. It's usually an addendum to the income statement, or perhaps on a different page. And we put it here just to save space in terms of what we're doing in class. Now, so here's the scenario. You're taking an exam, and you get a cash flow statement. And remember, every year every class I've ever taught accounting to has had to create cash flow statements on exams. So, is it likely you're going to have to do a cash flow statement? And I'd say it's as close to a probability 1 event as you'll ever see in your life. A little bit higher than taxes, because some people can avoid them. So, here we go. Let's create a cash flow statement for this relatively simple set of information. The first thing that I always suggest is that you draw a picture. Now, in this case, the picture is the general form for our cash flow statement. And the general form of our cash flow statement has 3 different sections. The first section is a cash flow from operations. The second section, and I'll put the second section on a different page, is cash flow from investing activities. Now, what are investing activities? And remember, that's a little bit confusing to most students. Investing activities to the firm are purchases of property, plant, and equipment. The firm invests in the things it needs to create a product. Different from you as an individual, when you make investments, generally talking buying stocks or bonds or your investment portfolio somehow defined, various assets. But from a firm's perspective, when we talk about investing, we're talking about the assets they use to create value in general. Now, firms also buy and sell other companies' stock. So buying and selling of stock is included, but primarily it's the fixed assets needed to create value. And the last section is cash flow from financing. Now, we're going to have various items, line items, that we're going to list in all these sections. And at the bottom, we are going to show that what we're targeting is net change in cash. So in this case, we already looked at the cash account, and the cash account, let me bring it back on. The cash account went from $300 to $320, so we have a net increase in cash of $20. So down here, I'm going to say net increase in cash, and this is what the whole thing has to tie into, is an increase of $20. So basically, it's a little bit like playing Jeopardy. We know the answer. The answer is that for this firm, cash increased by $20. However, now we have to fill in all the blanks to explain how the cash account went from $300 to $320. And the flow goes like this. If we go back to the first section, the first section is our cash flow from operations section. Now, this section, operations, comes primarily off the income statement. So the focus of cash flow from operations is going to be the cash that came in through operations, hence the income statement, hence what is our first best guess about the net cash flow from operations? And the answer is net income. Now, we're going to be creating an indirect cash flow statement, which means that we're going to start with net income as our first best guess about what cash would be, and then we're going to either add items that would have increased cash or subtract out items that would have used cash relative to a baseline of net income. So we're going to start with net income and then adjust net income for various transactions that the firm would have entered during the year and or adjustments or whatever. So we start with net income. So on our cash flow from operations section, we start with net income. And net income for the year, we go to our income statement and we pluck net income, 360, right off the income statement. So net income, 360, put it right here. That's where we start. Now what we do is we add to or subtract from net income. So our first best guess about cash flow for this period, in this case a year, is that net income gives us the best approximation. However, there are items on the income statement that are not cash outflows. Now, examples of that are depreciation, amortization, and depletion. Now, there are many others, but those are the three that we have covered in class that we all should be familiar with. Now, in this case, we go to our income statement and we look for items that are expenses on the income statement but are not cash outflows. So in this case, we go down and we see depreciation for 160. That is an expense on the income statement, but it is not a cash outflow. All these other items, cost of goods sold, operating expenses, in general would involve cash outflows. But depreciation comes from an asset that we could have purchased last year or the year before or whenever. Hence, that is not a cash outflow. So we add that back. So we start with net income, and we add back depreciation. And it's the depreciation on the income statement, not accumulated depreciation on the balance sheet. Right? That's not what we do here. In this case, it's the depreciation that affected net income this year. And the amount was 160. And on this particular income statement, there are no other items like amortization or depletion or anything else that would have affected it, so we will go on from there. The next thing we will do is we'll start analyzing the balance sheet, and we'll start analyzing things like accounts receivable, inventory, prepaid insurance. And the process is very easy. If we look at the accounts receivable, all we do is we take the difference from the beginning balance to the ending balance. So what we're going to be doing is taking the difference between the beginning balance of 400, ending balance 460 gives us a difference of 60. Now, the question becomes, when receivables increase by 60, what effect does that have on cash? And the way to think about it is, someone owes us the money. When receivables increase, it's as if we're giving them a loan. So it is as if cash flow is going down. And so in this case, with an increase in an asset, we would then subtract out the increase in accounts receivable and subtract out, in this case, $60. And I'm going to bracket $60 just so we know it's a decrease, so we don't confuse increases from decreases as we are going along. Now, notice what I did here. I have net income going all the way out to the right. I'm creating a separate column coming down here. This is not debits and credits or anything like that. All I'm doing is organizing it. I'm gonna list all the add backs or subtract froms in one column, bring out a total, and then come to total cash flow from operations at the bottom, just so you know where I'm heading with this. And the first thing we did was to analyze accounts receivable. The next thing is look at inventory. Inventory goes from 300 to 380. Aren't these numbers nice and juicy, easy to subtract? That's just wonderful, and you can thank me for that later. So we go back to our cash flow statement, and again, if inventory is going down, if inventory is increasing, it's increasing because we purchased inventory. And if we bought it, that means there was a cash outflow, so to speak. And again, it's as if there was a cash outflow when inventory increased. So we subtract out the increase in inventory. And that increase was $80. And again, we're subtracting that out, we're bracketing that. So we added back depreciation, then subtracted out the increase in inventory, the increase in receivables, and the increase in inventory. Next, we go to prepaid insurance. Prepaid insurance decreased from 60 to 20. So that decrease in prepaid insurance, the way to think about it is it's as if we sold that insurance to somebody else. Now, we didn't, but it's as if we sold it. Hence, that decrease of 40, we add back. We add back the decrease in prepaid insurance. And that increase was 40. And that was the difference here. 60 minus 20 is 40. So we're moving along, things are going fairly smoothly, we could start analyzing our long-term assets, but in fact, we will save that for later. Because the long-term assets, remember we said that investing section is devoted to what? It's devoted to purchases and or sales of fixed assets. So when we do the second section, the investing section, we'll analyze property, plant, and equipment, as well as its accumulated depreciation. Now, the next step is to start analyzing liabilities, in particular short-term liabilities. In this case, we start with the first one, accounts payable. Accounts payable increased from 360 to 420. That's an increase, and notice I'm giving you I'm kind of marking them off as I go in red. And that's just so I know that I have in fact included everything necessary. So it's kind of like a checklist as I go. Now, doing it my way doesn't necessarily make sense for you, as long as you understand that you need to be systematic about how you go through the information and make sure you've included everything. Why is that? And the reason is, as I've said in class, when I have done cash flow statements in real life, and I worked for an accounting firm for a number of years, I never, ever, not once, got a cash flow statement to balance the first time through, because there's so much detail that you always forget something or transpose a number or make an adding mistake or something. And so it's very important to be very systematic about how you analyze all the information, and that's what we're trying to show right here. So this accounts payable, we have an increase in a short-term liability. Okay, an increase in a liability means it's as if they are making a loan to us. They're saying, pay us later. That's what they're saying. So it's as if they are making a loan of cash to us for now. We have to pay it later. Hence, an increase in a liability is, an increase in a short-term liability is as if it's a cash inflow. So for accounts payable, we add back the increase in accounts payable. In this case, that increase was 60. Accrued expenses payable goes from 140 down to 60. There's a decrease. Now, why is there a decrease in this liability? And the answer is because we paid it off. We no longer owe the money. Hence, that is as if there is a cash outflow. So this decrease will subtract out the decrease in accrued expenses payable. And that decrease is 80. And we're subtracting it out, hence we'll bracket that amount. Next, income tax payable went from 40 to 60. And like accounts payable, there's an increase in the liability, so it's as if the government is making a loan to us saying, pay us later. So as of December 31st, we owe the government more money in taxes. That's not exactly a great thing. But in any case, on our cash flow statement, it's as if, right, we add back the increase in taxes payable. In this case, that increase is $20. Now, the next current liability is dividends payable. But remember, dividends do not appear on the income statement. Dividends are not an expense for tax purposes, hence they are not an expense for GAAP purposes. They only appear in retained earnings. Hence, in the cash flow statement, since it does not affect net income, it can't be added back to or subtracted from net income. It has no effect on net income. Whereas every other change we've talked about affects net income at least indirectly. So dividends payable, we will analyze that later. We'll analyze that when we are talking about the financing section, because dividends really are a financing decision. The firm decides how much to give its stockholders in the firm of dividends. Bonds payable. Notice bonds payable increased, but again, that increase will be included in our section on financing. And capital stock, common stock, increased, a financing decision. So at this point, we have pretty much done as much as we can do on our cash flow from operations section. There's one more item that we'll talk about a little bit later, which is the sale of the property, plant, and equipment. However, for now, we will start addressing the next topic, which is the cash flow from investing activities. So cash flow from investing is our next topic, and in order to do that, we are going to analyze the property, plant, and equipment accounts. And the property, plant, and equipment accounts, I'm bringing them back up right now. Property, plant, and equipment. The issue is, and we can see here, property, plant, and equipment increased, but so did depreciation. And the question is, how much cash went out the door to buy new equipment? Aha! Remember as well that cash came in the door because they sold equipment during the year. We go back to the income statement. Gain on sale is indicative of a sale of equipment during the year. Notice up top here, the gain of $40 is this gain that we're seeing right there. And so that affects property, plant, and equipment. So now the question to you is, how much cash came in the door from the sale of property, plant, and equipment, and how much cash went out the door from the purchase of property, plant, and equipment? And that's what we're going to do next. We're going to analyze those two parts of this particular gain. And in order to do that, I'm going to create some T accounts. And the T accounts, you've seen me use these T accounts many times in the past. This is the equipment account, an asset account, and accumulated depreciation, an asset account, but a contra asset account, right? It has a credit balance. And the way I always do it is I put depreciation expense to the right, horizontal from accumulated depreciation, because this depreciation expense is directly related to accumulated depreciation through the entries that we make for depreciation expense. Depreciation expense, an equity account, debits decrease, equities in total, credits increase. Now, I put in the basic information, and I go back to our income statement. And in the income statement, beginning balance is $1,000. So I have a $1,000 beginning balance. And notice I'm labeling it. And my ending balance in equipment, which I take right off the balance sheet, is $1,460. Nice double line indicating to me that that's the ending balance. Accumulated depreciation started out at $200. Ending balance in accumulated depreciation was $260. Nice double line. Now, what else do I know from the information that we've already reviewed? And the answer is, well, I know there was depreciation expense during the year. How much was depreciation expense during the year? And the answer is we go back to our income statement and we find depreciation expense. Depreciation expense on our income statement, $160. So we come in. How does that affect what's going on right now? It affects it by the entry they would have made would have been a debit to depreciation expense for $160 and a credit to accumulated depreciation for $160. Now, interesting enough, notice what happens. If we have a $200 beginning balance, plus $160 would be $360, yet we have an ending balance of $260. Hence, what had to have happened during the year? And the answer is that they would have sold equipment during the year, and when they sold the equipment, they would have purged or gotten rid of its accumulated depreciation, and the amount of that accumulated depreciation would be how much? And the answer is, well, it would have to have been $100 in order to get this account to balance. Now, let's create that entry when they sold the equipment. But before we do that, go back and think about what are we trying to accomplish here? What are we looking for? What we're looking for is the increases in equipment, which was a cash outflow, which we don't know yet. So we're looking for the increase in equipment. And we're also looking for the amount of cash that came in the door when they sold equipment. So what we're going to work on right now is the entry for when they sold that equipment. Now, when they sold that equipment, what would the entry have looked like? Well, they would have received some cash. And, as we saw here, they would get rid of, which is a debit, the accumulated depreciation. So they're increasing an asset even though they're decreasing the amount in the account, accumulated depreciation. And we just saw accumulated depreciation is 100. The amount of cash, we don't know yet. We also know that there was either a gain or a loss on this transaction. And we know from the income statement that we had a gain of $40. So a gain would be a credit. And we know that the item had a cost of a certain amount. So we're reducing an asset account, equipment, for some amount out here. And the question is how much, right? And if we go to the information at the top of the income statement, an item of PP&E was sold. The item had originally cost $140. Hence, what that tells us here is the equipment cost was $140. That allows us to then figure out this entry, right? 280 is the amount of credits. Excuse me, 180 is the amount of credits. Good adding, Bob. So the amount of cash that would have come in the door would have been 80. And that's one of the items that we're looking for, right? How much cash came in the door? So voila, part of our problem has been solved. In addition, we were able to take this 140. This 140 is a decrease in equipment. So if we bring that 140 over to our equipment account as a decrease, we can then figure out how much was purchased during the year, which is another thing that we are looking for. So our analysis is almost complete. Let's go back to our cash flow statements and fill in some of the information. So in our cash flow from investing section, the one thing we know is that we have a cash inflow, right, from sale of PP&E, or equipment, or again, I don't care how you label this, but that's a cash inflow of $80. And we also know from the purchase of PP&E, let's go back and calculate that. That would be a cash outflow. So if we go back and calculate that, what number, right, 140 and 1460 is 1600, hence 600 would be the increase in equipment here. So we go back to our cash flow statement, and the purchase of PP&E would then be 600. That 600 would be a cash outflow, so I'm going to bracket that. And we're almost finished. Now, wait a second. Why are we almost finished? And the answer is, well, if we go back to the entry that was made, and let me outline the entry a little bit here, right? This entry, notice that there was a gain on the sale of the asset. And yet all of the cash from that transaction was shown in our section on investing. However, the gain had an increase on the income statement, hence had an increase in net income. So this gain, we have to go back and adjust our cash flow from operations section. So I'm going back to our cash flow from operations section, and I'm going to adjust our net income figure. And what we're going to do is the gain would have increased net income. Hence, we're going to subtract out the gain of $40. And again, why is that? The reason is because all the cash from the transaction from the sale of that equipment was recognized in a separate section on the cash flow statement. So we have to adjust the operations section to account for that. When we add all these things up, what we find is that they total, that the column to the left totals 20. So we then run a total for our cash flow from operations and we get 380. So 380 then is total cash flow from operations. Are we finished? The answer is no. What have we accomplished so far? We've accomplished an analysis of our investing section, and if we total that up, our investing section, 80 came in, 600 went out, net of 580, net of 520, and that's a net cash outflow from investing. Let's go like that just to delineate things. Net cash outflow of 520. We have yet to do cash flow from financing. Now, the first thing we should do is something we mentioned earlier, which is dividends. How did dividends affect cash flow? And in order to do that, we're going to analyze the dividends account. So we go find another piece of paper, and we will analyze dividends. So dividends, create a T account, dividends payable. It's a liability account. Take the beginning and ending balances from the balance sheet. So I'm going back to the balance sheet, dividends payable. 0 beginning balance, $40 ending balance. So we have a 0 beginning balance, a $40 ending balance. Now we need to figure out what dividends were declared during the year. And the question is, where do you find that? And the answer is, well, if you look at the reconciliation of retained earnings, which in this case is at the bottom of the income statement, notice that dividends declared for the year were $100. Now, what was the entry when they were declared? The debit would have gone to dividends declared, credit would have gone to dividends payable. So we go back, during the year, what would have happened is dividends declared would have been debited for 100, dividends payable would have been credited for 100. So we had a 0 beginning balance, we declared dividends of 100. We currently, as of year end, owe 40, hence how much cash went out the door? And the answer is $60 went out to pay dividends. So we go back to our cash flow from financing section, and we say to pay dividends. And the amount that we just decided was what? What did we see? 60. So 60, and that's a cash outflow. Now, were there any other cash outflows or cash inflows from financing? And the answer is, well, the company floated bonds, and they also sold capital stock. So we go back to our balance sheet, and we look here, bonds payable. Bonds payable went from 100 up to 220. So there's an increase of 120. And that increase in the liability, remember from bonds, if the liability went up, that means cash came in. Hence, we go back to our cash flow statement. And for dividends, we have from the sale of bonds, we have 120, which is a cash inflow. The next cash inflow would be from the sale of common stock. Common stock increased by 100. Hence, the sale of common stock, the increase was 100. Now, we net these things, right? And 60, 120, 100 gives us a net of 160. And that's a net increase from financing. And here's where we have a drum roll. We go back and we look at the increase from operations, 380, plus 520, 380 less 520, plus 160, and lo and behold, it nets out to 20. So in fact, our cash flow statement balances, which is a very fortuitous thing. So much for our first cash flow statement. And again, the flow, I went through it fairly slowly, and hopefully the flow makes sense. Now we will move on to the second cash flow question, which is question 4. Let's go back and look at our roadmap. So up till now, what have we done? What we did was we did a comparatively easy. Neither one of them are all that difficult, to be honest. It's just that the numbers on the second one are a little more onerous. So we did question number 4. Now we are going to work through question number 6. So the problem with question number 6 in terms of what we're doing in class is the numbers are fairly large. And, you know, you all have calculators or spreadsheets or whatever that you can use. So I am not going to show you, I'm not going to do any adding or subtracting like I just did. I'm just going to give you the answers as we go through. Okay. T6, basic information. Information is a little bit different. The income statement. Sales less expenses, notice more realistic numbers. And what are we looking for? We're looking for things like depreciation expense, that's a non-cash item, amortization expense, a non-cash outflow, which is an expense, loss on disposal of machinery, right? That's going to affect our operations section as well. Put a little star next to that on the other side, a little bit different. Operating expenses, income tax expenses, all kinds of things typical of an income statement. Net income, 390. That goes right into our cash flow from operations section. The next thing is an analysis of stockholders' equity. Notice here, dividends were declared. Notice they also redeemed common stock to the tune of $22,000. So they have various financing decisions, the payment of dividends and the purchase of preferred stock, that will affect our analysis. The last thing is our balance sheet. In the balance sheet, we have various short-term assets. We have a number of longer-term assets. So we have patents. We have various things that we need to analyze. However, there's a trick on this particular question. And notice that in the last question, if you keep on this page, please, in the last question, we had a beginning balance on the left, ending balance on the right. And that was convenient. However, the way financial statements are often presented, they're often presented with the most current information in the first column, and then older information in succeeding columns. And that's the way this information is presented. So we have to reorient the way we analyze the balance sheet. In other words, this is the beginning balance here. This is the ending balance here. Right? 91 to the left, 92. So when we go, we're going from right to left when we take our differences. Again, a little bit different than the last one, but not catastrophic, but a little bit different, and something that we need to keep in mind as we go through this question, because it can make it a little bit complicated. Okay, here we go. What's our plan? Our plan is very simple. We draw a picture to help us organize the information. And the picture that we use for these kinds of questions, cash flow statements, is the simple format for the cash flow statement, the 3 sections. So the first section, cash flow from operations. And we'll have a number of items going down. Second section, I'll put on the next page. Cash flow from investing. The next section, cash flow from financing. And lastly, the net change in cash. Let's put the net change in cash in to start. So the net change in cash comes off the income statement, and the net change in cash, it went from 372 down to 290. So there's a net decrease in cash of $82,000. So in our statement down here, this is a net decrease in cash and a net decrease of $82,000. And I'm going to bracket that, and so that's the number we need to tie into, right? So our process now, let's review our process. Our process is going to be what? First thing we're going to do, we're going to start with the cash flow from operations section. We start with net income, add back any non-cash expenses on the income statement. Then we analyze short-term or current assets and short-term current liabilities to try to fill out our cash flow from operations section as much as we can. Second thing we do is we analyze property, plant, and equipment and try to get our section on investing pretty much cleaned up. The last thing we do is do our section on financing, cash flow from financing activities. And in this case, remember, we have two financing activities we already talked about. They bought back preferred stock and they paid dividends during the year. So we have to analyze both of those things. Okay, let's get started. Cash flow from operations, starting out with net income. So net income, back to our income statement. Net income for the year, $390,000. So net income, $390,000. Oops. Now, to that, we're going to add back or subtract out various items, right? And the first thing we're going to do is we're going to look for expenses on the income statement that were not cash outflows. Primary example being depreciation on virtually every income statement that's produced. We have some kind of depreciation, not necessarily, but almost. So we look for depreciation and we add back depreciation. In this case, we also add back amortization. Now, what gets amortized again? And the answer is intangible assets get amortized. Intangible assets like what? Intangible assets such as copyrights, patents, things like that. So in this case, the firm has some patents as an asset, and so you would amortize those patents. So we go to the income statement and pluck these numbers out. The depreciation expense, 198. Amortization from the income statement. Amortization expenses, 26,400. And again, these are added back, hence we are not going to bracket anything just yet. Next, and near as I can tell, there are not any other expenses on the income statement that are non-cash expenses that are obvious. Next thing we do is we go to our balance sheet and we analyze short-term assets and short-term liabilities. So in this particular example, we go to accounts receivable, and accounts receivable went from 512, went down. Remember, we're going from right to left, from 512 down to 478. Now, that's a difference of $34,000. So we plug that in, put that in. If it's a decrease in the asset, it's as if we sold it. So it's add back the decrease in accounts receivable to the tune of $34,000. Next, we look at inventories. Inventories, again, also decreased from 1,076 down to 966, which is a difference of $110,000. So on our cash flow from operations section, we add the decrease in inventories of 110. And now we have analyzed, right, all of the current assets, the difference between the cash account we put in at the end, accounts receivable, inventories in, long-term investments would not be part of operations, but would be part of our investing section. Machinery and equipment, obviously part of investing. Equipment improvement, another long-term account. Patents net, also a long-term account. We'll have to analyze that. Total assets, okay, so on we go. Next thing we do is we analyze our short-term liabilities. So in order to get a good picture of that, our short-term liabilities include what? In this case, we only have one, accounts payable. Accounts payable, remember going from right to left, accounts payable went from 210 up to 465. Now, that increase in accounts payable is as if there's an increase in cash. So let's put it in. So remember, we're going right to left. So on our cash flow statement, we are adding back this increase in accounts payable. And the difference from 465 to 210 is 255,600. And we are almost there. There is one other item here that we need to take care of. And if we go to our information, because we're going to start doing our long-term assets in a second, new machinery and equipment were acquired for $792. In addition, the machinery with a net book value of 120 was sold for $96. That's part of what we'll be doing in a second. So we have new equipment, $792. Second part, we have a sale. Legal costs of $4,000 were incurred in the successful defense of a patent. Income taxes for $92 and bond interest were paid as of year end. The assets which were amortized, the assets which were amortized are the patent and equipment improvement. Again, patent and equipment improvement. So the equipment improvement could have been a lease, which would be part of an intangible asset, or could be something like that, so that the amortization affected both the patent account and the equipment improvement account. So the only thing that we need to worry about right now are these legal costs of $4,000. And the legal costs of $4,000 were incurred in the successful defense of a patent. And what we are going to do, we're going to include that as a non-cash outflow here in our cash flow from operating activities. Although theoretically we could include that in our investing section, but I'm going to do it so it's consistent with the answers that you will have in the problem sets. So we are going to subtract out an amount for patent defense, and that was $4,000. So that's a cash outflow. And the only other thing that will affect our cash flow from operations section is the analysis of property, plant, and equipment, where we show a gain or a loss. In this case, we'll have a loss, and that will affect our cash flow from operations. Okay, next. So we are about finished with our operations section. It's time to move on to our section on investing. So the next thing is our section on investing. And the information on investing was what? Item number 1. New machinery was required for $792. So that tells us there's an increase in our equipment. In addition, machinery with a net book value of $122 was sold for $96,000. So that tells us we have $96,000 in cash that came in. So the two things, the things that we need to fill this, to do this analysis are what? It's actually given to us directly. We don't even have to analyze. We have new machinery was acquired for $792. That would be a cash out. The amount of cash that came in when this was sold was $96. In addition, we have the loss, which we already know, which appears on the income statement. So we don't even have to analyze property, plant, and equipment. We can just go right to the cash flow statement with these items. So then those items were what? The first item was to purchase equipment. And how much was purchased? $792, right? So they purchased equipment to the tune of $792,000. In addition, they sold equipment. And how much cash came in when it was sold? $96,000. So $96,000. The purchase of equipment was a cash outflow. The sale, $96,000, is the cash inflow. And there are there's one other item that we will need to analyze, however, and that is the long-term investment. So if we go to our balance sheet, which I have folded over here, if we go to our balance sheet, so up to this point, what have we analyzed? We've analyzed our machinery and equipment, right? They told us the difference there. They told us the amount that was increased. We've analyzed the accumulated depreciation. The equipment improvement account was due totally to the amortization, so we recognize that. Patents, we analyzed. The last thing that needs to be addressed is long-term investments. And notice long-term investments started at 0, and now we have an asset on the books for $300,000. How would that have affected our cash flow? And the answer is, well, it would represent a cash outflow. So if we analyze this, we see a $300,000 cash outflow. We take that information to our investing section, and this is a purchase of a long-term investment. And, I mean, what's an example of a long-term investment? They could be purchasing land for a future site. They could be, theoretically, in buying another company. They could be buying almost anything. So, I mean, almost anything could be included in this. In any case, $300,000 was the amount that is a cash outflow. Cash flow from financing. That's next. So those are the three items affecting our investing section. We can add all that stuff up. When we add all that stuff up, we see that we have a 996 net cash outflow from investing. Cash flow from financing. We go back to our balance sheet, look at what's going on. Notice that bonds increased from 600 to 700. Preferred stock changed from 80 to from 200. Excuse me, went the wrong way here, didn't I? Excuse me. Bonds payable decreased from 700 to 600 because we're going from right to left. So that's a net cash outflow because they retired those bonds. Preferred stock decreased from 200 to 180. But remember that we have an analysis of that particular preferred stock, and the difference here, which is 20, 200 minus 180 would be 20,000, does not represent the total difference because they actually had to pay 22,000 to purge that, to buy back that common stock, buy back that preferred stock. Common stock remained the same. So, and dividends payable. Dividends payable went from 0 to 80, and the question now becomes, how much cash went out the door to pay dividends? So let's analyze dividends first. So we go to analyze dividends. And dividends payable, a liability account, went from a 0 beginning balance to an $80 ending balance. And we then ask the question, what was declared during the year? And we go to the statement on the reconciliation of stockholders' equity, and we see that they declared $80,000 worth of dividends during the year. So the entry would have been what? Would have been a debit to dividends declared, a credit to dividends payable of 80. And notice that the amount they would have paid in cash is 0. Hence, dividends did not have an effect on cash flow this year. Next thing is if we go to that same statement, redemption of preferred stock, notice the total cash outflow for the redemption of the preferred stock was $22,000. So we then go to our section on our cash flow from financing section, and to purchase preferred stock, the total amount was $22,000. That's a cash outflow. In addition, again, there were 0 dividends paid. In addition, we saw, when we look at the balance sheet, that there was a decrease in bonds payable from 700 down to 600. They bought back or paid off, they purchased their bonds back to the tune of 100,000, the difference there. So if we add that up, the total here is 122. That's a net decrease. So if we look at our whole cash flow statement, the one thing we forgot to do, as I remember, is this equipment that was sold, we didn't go back and adjust the cash flow from operations section. So if we go back and think about that equipment that was sold, and that's why it's very important to be systematic, and I violated Boylan's first rule, be very systematic. Luckily I remembered it. So if we go back and reanalyze that sale of equipment, note on the income statement that there is a gain, or loss rather, a loss on disposal of machinery, or loss on the sale. So they got some cash, but they didn't get as much cash as they would have liked. Hence, we go back to our section on operations. And for that $26,000, that was a loss on the income statement. So a loss on the income statement would have reduced net income. However, the total cash impact from that loss appeared where? Appeared in the section on investing. Hence, what we need to do is go back and adjust the section on cash flow from operations, and we're going to add back that loss. And that loss was $26,000. So when we add everything up here, we get 646, giving us total cash flow from operations of 1,036, 1,036,000. Then we look at what happened in the other sections, right? So we have a net cash in from operations of 1,036,000, a net decrease in investing of 996, a net decrease of 122 in financing of again, that was 122, the two items. And we net everything together, and luckily, yet again, our cash flow statement balances. And we end up with that net decrease in cash of $82,000. Well, this particular question, again, is probably a little more complicated than anything you would see on an in-class exam. So that, this particular question, I believe, was given on a take-home exam, and students had a little bit longer time to think about it. But as I think you just saw, you can get most of the points very, very quickly on a cash flow statement because they're very simple differences. Okay, let's go back to our roadmap yet again. What did we do in this session? The focus was on cash flows. We did a comparatively easy one, question P4, a relatively more complicated one, but again, the key is to be very systematic. No matter how complicated the information becomes, systematically go through the information, and a cash flow statement will be fairly easy to create. Thank you very much.